What if I told you two people invested 1 lakh rupees in the same mutual fund on the same day, but after 5 years, one has 1.3 lakhs rupees and the other only 1.1 lakhs rupees? The reason is NAV and the hidden charges you probably never noticed. Stick around, this might be the most profitable 9 minutes of your financial life. Hey there! Welcome to Scalpers Club, where we decode money for real people, not just finance geeks. Today, we are diving deep into something that sounds boring but could save or earn you lakhs, NAV in mutual funds, and how charges quietly eat away at your returns. And trust me, after watching this, you'll never choose a mutual fund the same way again. Right pointing backhand index, don't forget to like, subscribe, and turn on a bell icon. Because we are dropping 100% real financial knowledge every week. What exactly is NAV? Let's break it down. NAV is equal to net asset value. It's basically the price of one unit of a mutual fund. Formula is NAV is equal to total assets liabilities divided by total units outstanding. Simple, right? But here's the kicker. NAV changes every day based on market movements and expenses. It's like the stock price of your mutual fund. Think of it like pizza. If you've got a 1000 rupee pizza and cut it into 10 slices, each slice is worth 100 rupees. That 100 rupees is your NAV. Now imagine cheese gets more expensive or the delivery guy takes a bite, your slice is worth less. That's what charges do to your NAV. NAV is calculated at the end of each business day after the market closes, typically around 9 p.m. IST. So if you invest at 2 p.m., the NAV you get is based on that day's closing calculation. In technical terms, this is called forward pricing, and it matters a lot for your timing. Now comes the truth most people don't tell you. Your returns aren't just based on market performance, they're reduced by multiple charges. First one is expense ratio. This is the percentage of your investment used to cover the fund's administrative and management costs. Regular plans will charge 1.5% to 2.25%, direct plans as low as 0.3% to 1%. Let's say you invest 1 lakh rupees in 2 plans, regular and direct. Over 10 years, even with the same fund, the direct plan can earn you 40,000 rupee to 1 lakh rupees more. Why? Lower expense ratio is equal to slower NAV erosion is equal to more compounding for you. Second is exit load. If you redeem your units before a certain time, usually 12 months, you might be charged 1%. Imagine investing 5 lakhs rupees and needing it in an emergency, you could lose 5,000 rupees instantly. Third is transaction costs and GST. Yes, every little fee adds up. They're all factored into NAV, so your units might be worth slightly less than expected. There is a big myth. People think this fund has a NAV of 200 rupees. That one is 20 rupees. I'll pick the cheaper one. It is wrong. Here's the truth, NAV is not like stock prices. A 200 rupee NAV fund could have performed brilliantly over years. A 20 rupee NAV fund could be new or simply underperforming. What matters is how much the NAV has grown over time, not the absolute number. Example, Fund A, NAV 100 rupee to 150 rupees in 5 years, 50% growth. Fund B, NAV 20 rupees to 0.24 rupees in 5 years, 20% growth. Which one's better? You tell me, comment below. If you're doing SIP, systematic investment plan, lower NAV is equal to you get more units, higher NAV is equal to fewer units, but that's okay if the fund is consistently performing. Key takeaway: focus on consistent NAV growth and low charges rather than obsessing over NAV values. It's not about how many units you have. It's about how much those units are worth after expenses. Smart investor tips: how to use NAV effectively. Use NAV to track fund performance. Compare NAV growth across 1, 3, and 5 years. Look for steady compounding. Choose direct plans when possible. Lower expense is equal to less NAV erosion is equal to higher wealth over time. Don't panic on market dips. NAV will fall in bear markets, but good funds bounce back. Stick to your goal-based strategy. Let's say Vinod and Rahul each invest 10 lakhs rupees in the same mutual fund, but Vinod chooses direct plan with expense ratio 0.8%. Rahul chooses regular plan with expense ratio 2.0%. After 10 years, assuming a return of 12%, Vinod ends with approx 31.06 lakhs rupees. Rahul ends with approx 27.27 lakhs rupees. That's a difference of nearly 3.8 lakhs rupees from the same fund. That's the silent power of NAV and expense ratio. Comment below, have you ever checked the expense ratio of your mutual fund? And do you invest in direct plans or regular plans? Let's compare in the comments. I'll be responding personally for the next 24 hours. Here's what you now know. NAV is equal to unit price of a mutual fund. It's calculated daily after market hours. Charges like expense ratio and exit load directly reduce your returns. Higher NAV doesn't mean expensive, it could mean more growth. If this video helped you decode the real impact of NAV, don't keep it to yourself. Like it, share it with your investing WhatsApp group, subscribe for more real-world finance, no jargon, just results. This is the Scalpers Club, where smart investing meets real life. Stay curious, stay invested, and as always, invest wisely.